Yeah, you're absolutely right, Mike. It's a little bit of a head fake. We thought the numbers looked pretty good on the tweet. Get the details. The details, a little bit of the devil in the details, with a little bit higher expenses, and the guidance really was the disappointing part. They really hit the numbers out of the park in the fourth quarter, the fiscal second quarter for Affirm. But their first half of 22, sort of the second half of their fiscal year guidance implies pretty much in line with where folks were before. This company is notoriously conservative when it comes to guidance. For example, this past quarter, they beat quite handily. I think that will continue, but I think the key issue here was the guidance before didn't include Amazon, and now it does. So I think people are looking for more, including myself.
Well, and the fact that it now includes Amazon and it seems a little bit more muted, I mean, isn't that not a concern given the fact that that relationship was considered to be a big plus?
Oh, yeah. No, I think that's really why the stock has pulled back so much. I think it's the guide not being more of a blowout like the quarter was. Again, it'll be interesting to see what they have to say on the conference call at 5 o'clock. They tend to be pretty detailed when they answer questions. They also tend to be conservative. So we're looking for tea leaves in there. I do think Amazon is a massive opportunity. Still looking for Shopify details as well, that they're also ramping quite quickly with Shopify. So all the numbers in the quarter, at least on the top line, look great. It's just the guidance that probably is reducing the enthusiasm after market.
In terms of looking out to the future, Chris, I mean, how do you view a company that's never operated in a bad economic environment? Because now we're on the cusp of declining credit quality. We're on the cusp of increasing delinquencies. And how do you view a firm's ability to navigate that?
That's a great question, Melissa. That's really why I was on the sidelines for so long. As I watched the stock run post Amazon last fall, I couldn't get quite comfortable with the credit risk that wasn't quite in the multiple. Now it's a lot more reasonably valued, which is why I decided to get back on board before this quarter. But you're right, credit can only really get worse from macro perspective from here. They did include some really good details on their credit quality by vintage year in this supplemental operating earnings release they put out tonight. So the numbers look pretty good. The provision expense came in light this quarter too, so it came in below our estimates. So I think the current markers look good. And then the key will be Affirm's ability to navigate the waters going forward. I really do think this company has an underwriting advantage. Their pool, their credit data, the data they collect from consumers, they will be ahead of the curve, but the overall and macro environment will certainly affect them.
I guess longer term, Chris, just in terms of the business model, how many years out are we looking at before it really turns profitable, until they get some kind of a scale all along, you know, other players coming into this general part of the market, including the big processors? It's just hard to know exactly what they have as a special sauce or a head start.
I'd say, Mike, that is a great question. That's actually one of the reasons behind my upgrade a couple weeks ago was, as the top line accelerates, there is a lot of operating leverage here. A lot of their costs that's caused them to be unprofitable should be fixed. This quarter, however, big increases in technology costs, big increases in G&A, so that below the line stuff is still increasing. So that needs to slow down for them to become profitable. And I think that's going to be an area of focus on the conference call. It's also about how big can they become, so that if they can really accelerate with Amazon and Shopify, as that top line expands, they can become profitable much more quickly. I'm not as concerned with the competition. Certainly it is a factor, but Affirm really has a differentiated model given their ability to lend to the consumer rather than just doing the merchant funded BNPL. And I think that has shined through with their examples of Amazon and Target and Walmart and probably more to come. So I don't think it's really competition that's really weighing on the outlook. I think hopefully it's just a conservative guide at this point.